In this video, we're going to discuss the generation or the potential generation of cash flows from your receivables. And the way I want to start thinking about this is your receivables is an asset on the books, and like any other asset, we can use it to generate cash flows. So whether that means you borrow against an asset or you sell that asset, either way, you're using that asset to generate cash flows. So what we'll have in this video is I'm going to discuss number one, borrowing against the receivables, which we would call it assigning or pledging the receivables. And then the other option, which is outright selling the receivables. That's going to be the topic or the discussion afterwards. So let's begin with the borrowing against your receivables. And the best way to explain this is simply through an example. So assume we have receivables of $500 in a particular company, and we're using those receivables to get a loan for $400. Now, upfront, the bank will charge us a discount fee of $50. This may or may not happen, but many times they do. So when we get this loan for $400 based on the collateral of $500, this is what we would do. We would get a check from the bank for $350, but we would have a liability of $400. So upfront, we would have this fee of $50 that needs to be accounted for. Now look at the fact that we're having a liability in our books. So currently we carry the receivables as an asset, these receivables, but the borrowing against them is now going to be recorded as a liability. Assume, and this is just for illustration purposes, but assume later on your customers pay you. The company gets paid by the customers. So you're going to receive cash of $500 from customers based on those accounts receivable. And then immediately what we would do as the terms of the loan come due, or as the loan comes due, we're going to pay the bank the $400 loan that we have. Now usually you'll have interest that accrues over that period of time. So whatever interest that is, we got to tack on to the payment to the bank. So it'll be the $400 of the loan plus any interest, I'm going to call that X here, plus any interest that needs to be paid. So your journal entry, or the way you would account for this, is you would reduce the liability for $400, increase the expense for interest for X amount, and then you would cut a check for $400 plus X. Now keep in mind that this transaction of the loan did not affect the way you account for your accounts receivable. It's still the company's accounts receivable, and they will collect, the company will collect on those receivables. Now contrast that to what we will do when we sell the receivables. That's what this is right here. So companies can, like I said, borrow against the receivables or outright sell those receivables. And sometimes the advantage of selling your receivables, one of the advantages perhaps, is that by selling them, you do not have to recognize a liability like you would in the case of assigning or pledging your receivables. So many times companies prefer to sell the receivables for that purpose, to avoid having to have a liability on their books. But real important is that for a company to be able to treat the exchange as a sale of receivables, there has to be some criteria that needs to be met. In essence, it's these three items right here that we'll discuss here in a minute, but I want you to think about what we're trying to make sure is happening. For a company to be able to recognize that transaction, the transaction of being able to generate cash flow from your receivables, for them to be able to recognize it as a sale, we are basically wanting to make sure that the company has surrendered full control of those accounts receivables. And these three criteria here are going to assure that that's the case. So let's look at them briefly. The first one is, and this is based on GAAP regulations, the first one is that the accounts receivable has been isolated. And in a sense, what that means is that it's beyond the reach, this should be the reach, sorry, beyond the reach of the company itself or of its creditors. So it's no longer an asset that belongs to the company. It's an asset that belongs to the factor, the company that buys our receivables. And because of that, this is rule number 2. For us to be able to consider it a sale, the factor has to have the right to be able to pledge or exchange those receivables. And what that's telling us is that the factor basically owns the receivables, right? And the company, in essence, has surrendered control over those receivables. And then the third criteria that needs to be met for it to be considered a sale is that the company itself does not maintain effective control over the accounts receivable. So, an effective control could be through an agreement to have to repurchase or redeem those receivables before maturity. So we are, with these 3 items here that we want to make sure occur, we are verifying that the company actually has surrendered control of the AR. And if that is the case, then the company can recognize it as a receivable. If any of these criteria are not met, then any transaction in which a company generates cash flows from receivables is most likely going to be considered a borrowing, in which case a liability would have to go in the books. Okay, so I hope you can appreciate that. This criteria here is to limit the ability, not limit, but to make sure that if we are going to recognize it as a sale, that it is a surrender of control. If it is not a surrender of control of the accounts receivable, then it by default goes back to a borrowing in the way that we have to recognize it. Okay, so assuming this criteria has been met, then here are the 2 possibilities. The company could sell these receivables without recourse. In other words, with no guarantee of goodness of those receivables. You can think of recourse as a warranty. So you could sell your accounts receivable with no warranty or without recourse, or you could sell the receivables with recourse or with a warranty that they're good. Because in other words, what we're saying here is, I'm selling you my receivables, and the factor is going to later collect on those receivables. Well, do we guarantee that the factor will collect their full amount? If you're without recourse, we don't guarantee it. If you're selling the receivables with recourse, then we're guaranteeing that the factor will get their full money. And if for some reason they don't get their full money, we would have to pay that amount. So let me illustrate here with an example. Let's do the 2A example without recourse. Assume again that the company has $500 in accounts receivable, and Allison, the factor, paid us 98% for our receivables. So the discount, or the fee that the factor is charging us, is 2%. 2% of 500 is $10. So what we would have is, we would have debit cash for $490, which is the amount that we're getting from this factor, and then the fee for us to get our money ahead of time is $10, and that would just be an expense or a loss. And since this is a sale of receivables, then we remove the accounts receivables from the books. And that's it. And the transaction ends here. You don't have to do anything else because you sold these receivables without recourse. The collectability or the risk of loss is now assumed by the factor, or in this case, Allison. Okay? Let's compare that to selling the receivables with recourse, okay? Here, same example. Company has $500 in accounts receivable, and the company sells to Allison for 98%. So that's still the same. But the company estimates that $5 of that 500 will be uncollectible. So because of that, we might have to pay the factor up to $5, or if it's more than that, we have to pay the amount, but whatever it is, but we think it's going to be $5. If at the end Allison does not collect the full 500, we're in the hook to be able to pay that, because we're guaranteeing we're selling these receivables with recourse. So notice what happens. We still get $490 from the sale. We still remove our accounts receivable for the whole 500, but now we add a recourse liability, which may require us to pay in the future. So in conclusion, our loss is now the original 10 that we had before plus the amount that we're guaranteeing for the receivables. And what happens next is, well, it depends on whether the factor is able to collect everything. So if the factor, Allison, in the future collects the full 500 from our customers, then we can reverse this liability. Notice how this would be the case. We would reduce the recourse liability and we would put that back in revenue. Because if you recall, when we initially recorded this liability, we added more expense. So in a sense, it's reversing that out. And if you haven't closed the books, by the way, you could credit loss for the $5. You know, the same account that you're using right here, you could just reverse that. But many times this is in a different period, and what will happen is that this loss would have been closed in the books in an earlier period. So we could just put it back in revenue if that's the case. Okay? And then another possibility is that Allison, the factor, does not receive the full amount. And if that's the case, we have reserved a liability for that contingency. So notice this example here, and it could be anything, any amount. If it's $2 that is uncollectible, in other words, Allison received $498 of the total 500 receivables. And Allison contacts us and says and tells us that they never collected two from an accounts receivable. In that case, we have to send Allison that $2, and that's what this reduction of cash right here of $2 is. Because remember, we guaranteed, or we guaranteed the receivables. It was the sale with recourse. Now, the reversal of the liability is for the full amount, the full 5. Even though we were expecting a loss of 5, it only turned out to be a loss of 2, so we put those extra 3 back in revenue, just like we did here, but for a lesser amount. Okay? So that's the illustration or the comparison between selling your receivables without recourse versus selling your receivables with recourse. The only added factor here is that you have this liability that you have to set up for the potential loss that you're exposing yourself to from selling them with recourse. All right, let's go back to example 2A without recourse. Another thing that can arise when you sell your receivables is the fact that the factor themselves, Allison in this case, may want to keep some money in case there are issues like customer returns or customer discounts. In other words, some customers take advantage of paying early and they get discount, and or other adjustments. And if these things occur, then Allison again is not going to receive the whole $500, right? So sometimes the factor decides to keep some of the money, and then if there aren't any issues, that extra money is given to us at the end of the period. So let's compare here. When we first sold these receivables without recourse, we received $490. Okay, and then same information stands, except that the factor says, let me keep $4 of those $490 just in case there are returns or discounts or anything like that. And if there aren't, I'll give you that $4 later. So with the way we would deal with that is with this account due from factor, and this is a receivable. So we have a receivable from the factor because they're keeping those $4, and everything else stays the same. You reduce the accounts receivable for the same 500. The loss is still $10, but the only difference is that you're going to receive right now a check for $486 instead of the $490. And then that extra $4 you may get in the future. Okay, and before I illustrate what happens in the future, I want to make sure that we're clear on something. This money due from factor that we're accounting for, this is very different than this idea of the recourse liability. The recourse liability is something that the company may have to pay later on, dealing with uncollectability of receivables. So this is a potential cash outflow in the future for uncollectability. This idea of the due from factor has nothing to do with uncollectability. It's about other issues besides collectability. It's issues about customers possibly returning some of these items. And if they return them, well, their accounts receivable balance goes down. If they get discounts, their accounts receivables go down. And hence, Allison would receive less. So these items of due from factor is the opposite in terms of the cash flow. This is potential cash flow that we may receive from the factor in the future. Whereas this is potential cash flow that I may pay out to the factor in the future. Okay, so don't mix those two up, please. So this is due from factor or receivable, and that's an asset, and this is a liability over here in the case of the recourse liability. Okay, so now let's go back to what can happen in the future here. Assume that afterwards, Allison, the factor, is able to collect the full $500 from clients. There were no returns, there were no discounts, everything was fine. In that case, I would get a check for $4 from Allison, and I would be back in the same position that I was right here, because that would have been $486 plus 4. I will receive the full $490, and then I reduce the due from factor account. Here I just abbreviated so it would fit, but this is DFF. Okay, and another possibility is that maybe there were some returns. Okay, and if there were some returns, and that amount is $3, then Allison would receive $497 of the 500 receivables. In other words, our customers, would pay their receivables in the full amount of $497. Allison would receive that $497. And then we would be contacted, and Allison would say, listen, I only received $497, 3 of which was related to discounts, returns, and this we informed the factor about. And then because of that, Allison is only going to send us one of the $4. So we get a check for $1, and then we recognize the loss of 3 for the returns, and then credit the due from factor for the full $4. And it may be weird to see this as a loss, but what you have to think about is that when we as a company initially recorded these receivables, this is in the past, we did accounts receivable 500, and then we credited sales revenue or whatever 500. So currently in our books, and this is just for illustration here, currently in our books we have a revenue of 500. If clients return things, then this revenue would have been reduced. That would mean that if customers returned items, the revenue of 500 is overstated. So the way we deal with that is we record a loss of 3 so that we can also have the net income balance out to be 497, or the revenue in this case, the revenue of 497. Okay, so that's what would happen there. And also, I think it's important to note that this concept of due from factor can also exist in the scenario of selling your receivables with recourse. So this could have both the idea of having to account for a recourse liability, and as well have to account for a due from factor component here. The due from factor, as was illustrated here, would simply reduce the cash that you receive right now. So if you had to combine this concept in here, it would be due from factor 4, and then the cash inflow would be 486. And the same discussion here would apply later on in the future. And you can treat these two things separately. This is an issue dealing with uncollectability, the recourse liability, and then this is a separate issue dealing with potential returns or discounts or adjustments. Okay. On a final note, just want to make sure we're very clear. We have an asset, we have receivables, and we can generate cash flows from these receivables. One of the ways is to borrow against those receivables, and the other way is to sell those receivables. But to be able to recognize that transaction as a sale, we got to make sure we meet this criteria. And if the company does not meet this criteria, then by default, even though the company might be wanting to record it as a sale, by default, it would be considered possibly a loan instead of a sale of receivables. This concludes the video on generating cash flows from your receivables.